Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. I hope you all had a lovely weekend. Before we jump into the main stories, a quick update in China-US relations. Over the weekend, US President Joe Biden said that he would be having a phone conversation with General Secretary Xi Jinping soon, and that he was in the process of deciding whether to ease US tariffs on China, telling reporters on Saturday, quote, "I'm in the process of making up my mind," end quote. Biden declined to say when he would talk to Xi. Okay, let's start with ongoing infrastructure stimulus developments. This year, of course, with the Party Congress, is a sensitive year for the party, so politically acceptable growth will be required. Officially, the goal, as we know, is 5.5%, but even Premier Li Keqiang has admitted that this will be unattainable, even with massive stimulus. Reduced exports, sluggish consumption, and a property downturn driven by the evergreen housing crisis are all pulling down growth this year. These have all been exacerbated, of course, by the 2-month lockdown of Shanghai, the zero COVID policy generally, and international events like the war in Ukraine and inflation. So Beijing must turn to infrastructure once again to see any positive growth. A lot of infrastructure. Wang Tao, head of China Economic Research at UBS Investment Bank, has forecast that China's infrastructure investment will grow between 10 and 15% year-on-year in the second quarter and more than 8% for the entire year. Other analysts are skeptical that China can achieve high levels of infrastructure spending in the current zero-COVID policy environment. Quote, "We believe it is unrealistic to expect much faster infrastructure investment growth than 5% this year, and the 5% real growth would only fill a small part of the gap left by slowing export growth, the large contraction in the property sector, and the rising costs of the pandemic." End quote. Whatever the final number and price tag is, it's expected that this will be paid for through relaxing controls on local government financing vehicles and opening up more special purpose bonds for local governments. According to the Ministry of Finance, as of the beginning of June this year, local governments had issued 1.85 trillion yuan worth of special purpose bonds this year, an increase of 1.36 trillion over the same period last year. Local governments have an inventory of 71,000 projects set to be funded with special purpose bonds. Now, who will buy these bonds? State-owned banks, state-owned enterprises, private and public financial institutes, and domestic institutional and retail investors. The debt will mostly be held within the system. Easing restrictions on local government financing vehicles is also making some analysts concerned. Quote, "Chinese authorities have long been trying to clean up hidden local government debt attached to risky local government financing vehicles, PPPs, public-private partnerships, and other channels, which had funded infrastructure and public welfare projects. However, many of these projects did not turn out to be commercially viable and suffered from low returns." End quote. China has claimed that new spending will go into so-called new infrastructure, that is advanced or future technology. Indeed, according to the State-Owned Assets Supervision and Administration Commission of the State Council over the weekend, China's state-owned enterprises plan to invest over 10 trillion RMB, $1.49 trillion US, in more than 1,300 new infrastructure-related projects across the country during the 14th five-year plan period, 2021 through 25. New infrastructure refers to critical facilities based on information technologies like 5G, artificial intelligence, industrial internet, and the Internet of Things, according to the regulator. While this is certainly a lot of funding and no doubt will result in some breakthroughs and productivity gains, it's not enough to replace traditional infrastructure spending if the government needs to spend more on infrastructure. Quote, "This proposed program illustrates just how difficult it will be for Beijing to manage its long-promised transition from overinvesting in non-productive property and infrastructure to investing in new economy, infrastructure and manufacturing. 10 trillion RMB over 5 years will represent just over 1% of China's GDP during that period. China, however, currently invests 40 to 45% of its GDP, double the global average, of which roughly 2/3 has gone into property and infrastructure. Even if they double or triple their proposed investment in new infrastructure, in other words, it will be hard for these sectors of the economy to absorb even a small fraction of what they need to absorb. There still must be a huge net decline in investment." End quote. Thus, most of the infrastructure spending will go into traditional projects, high-speed rail, airports, bridges, etc. Projects which, as we have explored before in previous videos, no longer provide healthy productivity gains. Specifically, according to the Central Financial and Economic Affairs Commission, Beijing plans on building more coastal and inland ports and waterways, distributed small power grids, low-carbon energy bases, as well as oil and gas pipelines. More intercity railway networks have been promised too. The powerful National Development and Reform Commission has also identified 102 major projects outlined in China's 5-year plan for 2021 through 25, including third-generation nuclear reactors in Fujian province, the massive hydropower station in Sichuan province, and a section of the expensive and complex Sichuan-Tibet Railway. So there is a lot of infrastructure stimulus coming. The question is, how sustainable is this old playbook, and can Beijing transition to a new growth model in time? Quote, "If we look back at China's history of stimulating the economy with high investment, this kind of short-term counter-secular strategy does not guarantee a reasonable level of employment, nor does it ensure improvement in the proportion of household income and national income. The reality is that China's 30 years of infrastructure frenzy and 20 years of rapid real estate growth are coming to an end." End quote. If you enjoyed the episode, guys, don't forget to hit the like button, and for anyone who wants to help keep the channel financially sustainable, which is a tremendous help for the channel, Patreon, Buy Me a Coffee, and crypto links are in the description below. Thank you so much, everybody, for the ongoing support. Okay, now let's move to China's housing market, and China's property crisis and property woes continue into this month. Despite now fairly robust easing on restrictions, particularly on the demand side, as well as effective price floors to prevent price reductions, on paper at least, China saw average new home prices drop once again in May. According to National Bureau of Statistics data, average new home prices in 70 major cities dropped 0.1% on a month-on-month basis in May, after a 0.2% decline in April. From a year earlier, prices slipped 0.1% down for the first time since September 2015, and retreating from a 0.7% gain in April. Because of the sensitivities surrounding home prices, we need to take this data with a grain of salt. It tells us, though, at the very least, that home prices are facing strong downward pressure. In May, 25 out of 70 cities surveyed by the National Bureau of Statistics reported an uptick in new home prices from the previous month, compared with 18 cities recording a gain in April. The bright spot were the first-tier cities, urban centres which have typically and traditionally been the hottest property markets. Prices of new residential units in the 4 Tier 1 cities, Beijing, Shanghai, Guangzhou, and Shenzhen, increased 0.4% on average in May, compared to 0.2% in April. But the property sector in small cities saw monthly new home prices down for the 9th month. This is likely driven by weaker growth fundamentals, including net population outflows and stock oversupply. We will explore China's housing crisis more later this week. Okay, that is today's episode. Thank you so much, everybody, for watching. I'll see you tomorrow.